Hello traders, you are welcome back to the Forex Geek channel. In this video, we are diving deep into the best moving averages for day trading, Forex and stocks, and how you can use them to enhance your trading strategies. So whether you are a seasoned trader or just starting, moving averages are essential tools for identifying market trends, timing entries, and making more informed decisions in both Forex and stocks. Before we dive in, make sure to like this video if you find the content useful, and don't forget to subscribe to the channel so you don't miss out on future trading tips and strategies. Now let us start with the basics. What exactly are moving averages? Now, a moving average is a mathematical calculation used to smooth out price action by filtering out the day-to-day price fluctuations, right? And essentially, it helps traders identify the direction of the trend over a specific period, be it in Forex, stocks, or other markets. Now, there are several types of moving averages, but the most popular ones are the simple moving average and the exponential moving average. Both are used to confirm trends, but they are calculated differently. The key difference lies in how they weight the data. For example, the EMA, which is the exponential moving average, it it places more emphasis on recent price action, making it more responsive to recent market movement. While the SMA, right? While the SMA gives equal weight to all prices within the selected period. So now that we understand the basics, let us dive into some of the best moving averages that traders use for day trading. So let us start with the 50 period moving average, okay? The one that I have already added to the chart, okay? So one of the most commonly used moving averages for day trading is the 50 period moving average. The 50 period SMA or EMA is often used to identify the medium term trend. It's a fantastic moving average for spotting potential reversals or confirming the trend direction. Here's how you can use it for trend identification. Now, if the price is above the 50 period moving average, it's typically an indication of an uptrend. Conversely, if the price is below the 50 period moving average, it's a signal that the market is in a downtrend. Now, you can also use it for your exit and entry points. If the price is bouncing off the 50 period moving average, that could be a strong confirmation for your entry. For example, in an uptrend, you might look for buy opportunities when the price pulls back to the 50 period moving average, then moves back up. On the flip side, in a downtrend, the same logic applies for short entries, okay? It's an excellent tool for smoothing out price action, or rather for smoothing out market noise and identifying the overall direction. Then the second indicator is the 200 period moving average, right? 200 period moving average. Sorry about that. Now, this is a staple for long-term trend traders, but also very useful in day trading for confirmation. Now, the 200 period moving average is often referred to as the market heartbeat. It helps traders to see the broader trend and spot potential reversals or major support and resistance levels. Okay, now if you are trading forex or stocks, the 200 period moving average can act as a key level of support or resistance. If the price crosses above the 200 period moving average, it confirms that the market is in an overall uptrend. Okay, then if it crosses below, the downtrend is confirmed. Now, traders often use the 200 period moving average in combination with shorter term moving averages like the 50 period moving average, for example, okay, just to confirm trades. Okay, so for example, if the 50 period moving average crosses above the 200 period moving average, that's a bullish signal. Conversely, if the 50 period moving average crosses below the 200 period moving average, that's a bearish, signals a bearish market. All right. So for those of you who prefer short-term trading, the 20 period moving average is an excellent tool as well. Okay. So it is actually, let me just add the 20 period moving average to the chart. Now, the 20 period moving average allows you to capture changes with ease. It is more responsive to price action than the 50 and 200 period moving averages. Okay, and it is ideal for traders looking to get in and out of trades quickly. So for quick trend reversals in day trading, quick trend changes often happen, right? So the 20 period moving average allows you to capture those changes with ease. If the price crosses above or below the 20 period moving average, that could indicate a shift in momentum, giving you an opportunity to trade the reversal. Then for tight stops, the 20 period moving average is perfect for setting tight stop losses. All right. If the price moves in the opposite direction, you can use this moving average to get out of the trade quickly, minimizing your risk. So this moving average is incredibly valuable for capturing those small intraday moves and making quick decisions in the fast-paced markets like Forex and stocks. Now, one of the most popular strategies with moving averages is the crossover strategy. Right, that's one of the popular strategies with the moving averages. The crossover strategies. So this technique works by combining two moving averages, one short term and one long term. So there's something we call the golden cross. Okay, a golden cross occurs when a short term moving average, like the 50 period moving average, crosses above the long term moving average, like the 200 period moving average. So this is considered a bullish signal, suggesting that the market is likely to continue trending higher. Then we also have the death cross, right? The death cross happens when the short-term moving average crosses below the long-term moving average. This is a bearish signal indicating that the markets could be heading lower. So this crossover strategy is widely used in day trading because it gives traders clear buy and sell signals based on market momentum. So now, what are the best practices for using moving averages in day trading? First of all, use multiple time frames. Okay, don't just rely on one time frame. For example, you can use the 5-minute chart for entries, the 15-minute chart for confirmations, and the 1-hour chart to get a broader picture of the trend. Also, combine with other indicators to enhance the reliability of moving averages. Combine them with other indicators like RSI, for example, the relative strength index, okay, or maybe MACD to confirm signals. For example, if the price crosses above the 50 period moving average and RSI shows that the market is not overbought, that could be a solid buy signal. Okay, and also adapt to market conditions. The effectiveness of moving averages can vary depending on the market. In a strong trending market, they can be incredibly useful, but in sideways markets, you might want to adjust your strategy and use them as dynamic support and resistance levels. All right. So to summarize, the 50 period and 200 period moving averages are some of the best tools for day trading in stocks, Forex, and crypto. Now, these moving averages help you identify trends, potential entry points, and risk management strategies. By understanding how to use these moving averages in combination with other indicators and adjusting for market conditions, you can greatly improve your trading decisions and develop a more comprehensive strategy. If you found this video helpful, make sure to like this video and subscribe to the channel for more trading strategies and tips. Thank you for watching and good luck with your trades.